Good morning. It's Friday, the 14th of February, and this is Govindraj Ethiraj, headquartered and broadcasting usually from Mumbai, but still in transit. Our top stories and themes. The market slide for the seventh day, even as Asian markets perk up. And the small cap versus the large cap debate. The new income tax bill will be old when it arrives. And how India is using gas to power economic growth.
This is the Core Report with Govindraj Ethiraj.
The markets are down for the seventh day. Another day of close combat between the bulls and bears today as the indices swung from loss to profit and then back again. Of course, it's a familiar pattern as well. The 30-share Sensex was down 32 points at 76,138 from its previous close, but it moved over 750 points during the day. The Nifty50 was down about 13 points at 23,031. The Nifty mid-cap and the Nifty small-cap were up and down respectively. The mid-cap was up slightly, about 0.25%, and Nifty small-cap was also down about 0.3%. Now, let's take a look at what happened in the Asia-Pacific markets just to see what's happening around the world. They were all trading higher on Thursday and took a different path from Wall Street, which had fallen overnight because of stronger than expected US inflation expectations. Interestingly, Australia's S&P ASX 200, I know we don't talk about it much, hit a record intraday high, surpassing its previous peaks scaled on Jan 31st, according to CNBC. Other Asian indices like Japan's Nikkei 225 topics, South Korea's Kospi were all about 1% higher. Hang Seng of Hong Kong was higher. Only mainland China was down, and that too only marginally. Back home, and quite interestingly, India's small and mid-cap stocks are likely to decline for the first time in 3 years as the government scales back spending in favor of tax breaks to boost consumption, according to a Bank of America strategist. This segment, dominated by infrastructure-linked firms, had raced ahead of the broader markets in the last 2 years. Shares of these companies that also include a few state-run companies have traded at high valuations thanks to their low floats and demand from mutual funds, leading to a lot of liquidity chasing the same stocks, according to Bank of America, quoted by Bloomberg. Now, all of this is obviously turning. The government's policies have seemingly moved towards balancing capex and consumption versus being primarily focused on capex. The research head said, that's the bank's research head said in that report quoted on Bloomberg. The capex cycle is reversed and a moderating growth would impact many sectors and stock linked to this scheme. Meanwhile, the Bombay Stock Exchange's gauge of mid and small cap shares, in which a third of the constituents are industrial and capital goods, has fallen about 13% this year, which compares to a 2% fall in the main index as investors are obviously switching to large cap stocks. In August last year, interestingly, the same Bank of America analyst had warned that slowing earnings growth, a weak global macro environment, as well as high valuations posed a threat to Indian stocks, according to Bloomberg. So very broadly, and to recap once again, the BSE Sensex has plunged about 11% since hitting its record high on September 26, 2024. Meanwhile, there is that ongoing debate on systematic investment plans, particularly those that go into smaller cap stocks, the immediate future of which, of course, is looking a little grim. But I do stress on the fact it's immediate future. Because be that as it may, it's of course very likely that if you began your capital market journey 4 years ago, as many did thanks to proliferating free and usually misguided and inexperienced advice, combined with slick broking apps, then you're quite likely looking at a haircut. On the other hand, the whole idea of SIP is to invest over a period of time so it equalizes and then begins to compound. That's the very principle of long-term investing. It is, of course, a fact that the longer the bull run, the more we tend to forget history and cycles. The many analysts we speak to on the Core Report, for example, are confident that there are good buys even in small caps today, but it will take time, one, to spot them, and second, for them to flower, so to speak. And then the NSE Nifty50 is also down about 12% from its all-time high of 26,277. The Nifty Mid-Cap 100 is down 16%. The Nifty Small-Cap 100 is down 18% from all of their respective highs. On the other hand, as we reported yesterday, mutual funds are still seeing strong inflows, including in the month of January, which was ahead or rather more than the average monthly inflows for the calendar year 2024. Now that there is a small cap versus large cap debate evolving quite interestingly, how are veteran investors and fund managers looking at it? I speak with Avinash Gorakshakar, head research at Profitmart Securities, and I begin by asking him how he is building his portfolios.
Govind, first of all, when you construct a portfolio, you need to understand what is the risk profile of the investor. What is the kind of appetite the investor holds for the kind of risk he's willing enough to take in the markets. My sense is that when we talk to clients, we tell them what is their risk appetite. And accordingly, I think the normal percentage of large cap versus small cap or mid cap, as you say, is about 70% large caps and 30% small to mid cap. Because typically what we see in small cap and mid caps is that these provide very large alpha opportunities over the next, say, 3 to 5 years. And I think, that is probably the reason, very strong interest by a lot of investors, especially even the larger PMSs, the AI funds, the institutional guys, because obviously the capital multiplication happens much faster in these smaller companies. So I think there's a fair amount of risk involved, but obviously the risk reward is also equally large. But the most important part is that I think valuations have to be really comfortable to get in, because if you make a mistake on the valuation, liquidity is extremely tight in these counters. If you make a mistake, even exiting such stocks takes a long time. So I think broadly 70-30 is what we do for clients. And I think it again differs from client to client because risk appetite differs.
Right. If you look at this 30-70, which is today, and you go back, let's say 10 or 15 years, when maybe the composition used to be a little different, and maybe the small caps were much smaller, and the valuations were also lower, would we have seen this level of interest as we are seeing today, or the levels of interest remain the same over time?
Levels of interest have definitely increased significantly over the last, say, 2 to 3 years. And I think this is more prevalent in the small SME segment. I presume, small, medium enterprises have been the biggest kind of contributors to the small and mid cap because, we have been seeing IPOs oversubscribed by almost 500 times, 1,000 times. So there's been a lot of retail interest which has got into these kind of companies. And I think this was not the case about 10 years back. First of all, regulation point of view, there were hardly any companies which went public. People were quite skeptical about these companies because most of the promoters, the balance sheets were not up to order. But more and more professionalism has now come in this sector. And therefore, you have seen a lot of interest now. So, what was 10 years back is completely different from what is currently the situation. In fact, today, there are many dedicated AI funds who have come only to invest in SME companies. And the size of these funds is quite gigantic, 500 crores, 1,000 crores, 1,500 crores only for putting money in SME companies. So I think liquidity has also come in. Large institutional investors, FIs have also started putting money in these companies. So the whole complexion of the game has changed because we've got large investors also participating in these companies.
So if we are saying that today the quantum, even proportionately, of money going into small caps is much higher than ever before, therefore, would it be correct to say that valuations are also therefore at levels that we are not able to now understand or manage?
Yeah, I think this is definitely a very valid kind of, conclusion from our side also, because we feel that, there's a lot of liquidity chasing a lot of stocks. And that's the key reason we find that most of these companies get valued at absurd kind of valuations. I think, frankly, even if the business is great, if you buy a stock, a small and mid cap stock, at a very high valuation, the margin of safety is compromised right from day one. So I think, yes, you're right. I think clearly valuations have been on the tipping side. I think what we have seen now is just the beginning of a correction. And I think, see, I may be wrong in saying this, but typically, investors who enter this segment have also got to realize that with higher reward comes a higher risk, which is not the case in case of large caps. So large caps offer you a much better comfort. But yes, I think in the longer term, I think somebody who's got the patience and the conviction to hold on for a long time, I think can definitely think of making good money in the small and mid cap. But unfortunately, most of the investors who have come post-COVID, they want fast returns, and they are unlikely, those kind of investors who would be willing enough to put 5 years or 10 years in this segment.
Therefore, those who've invested as through the SIP route have also been relatively impatient or are impatient. Because, SIP, I would think, is usually means you hold on for several years so that you allow time to even out everything else.
To be very honest, SIP is meant to be at least a 10-year or a 15-year journey. But honestly, we come across very, very few investors who have the patience and conviction to invest for such long periods. I think everybody looks at the last 12-month returns and then decide, what SIP needs to do. And the moment the market corrects, or maybe it remains flattish or it corrects for 2 months, these investors start discontinuing their SIP. So it's unfortunate, but retail investors don't have the staying power. So that's the main reason why so much panic has been spread out. And people are now panicky, because the moment they see a correction and continuous selling, they feel that's the end of the journey for them.
How would you advise those who are wanting to invest or have invested recently, let's say in the last 3-4 years? One is to tell them that to hold on, but beyond that, what is it that you would say?
my sense is whenever we put our money on any mid cap, small cap, or SME company, we first look at the business and the promoter quality. See, I think unless these two things are really considered perfect and we do a kind of a proper due diligence from our side, we don't take a short term call. See, in the short term, I think the prices may go up purely on the narrative. But in the longer term, it's going to be only the earnings which decides the price earning multiple and which decides the future, wealth creation journey. So I think, investors who have put their money in good companies, I think need to give some time. It's not that, markets would not come up, liquidity would not come in. The best part is there are large investors now who are willing enough to put money and stay invested here. It's not only a retail kind of segment which, drives these stocks. But yes, I think a lot of correction may happen. And I think, for that, investors need to be a little patient and a little stronger in accepting the fact that booking a loss actually would not help them. I think you need to take the pain in the short term. Longer term, I think things will improve.
In your own investing approach right now, are you seeing smaller caps or mid caps which are still worth buying?
I think it depends on your risk appetite and the kind of investment time frame. We have got many companies, which have got market cap ranging from 250 crores to 500 crores. I think the most important question we need to ask is that do you want to multiply your capital in the next, say, 3 to 4 years? And do you have that kind of time frame in mind? Because if you have a 6-month or a 1-year kind of time frame, I think then this is not the place to be because, the risk appetite is also equally high. And obviously, the rewards can come only for those investors who can stay invested for a longer term. So we are investing. Yes, we are finding many companies interesting and worthy of investment. But here we need to take a slightly moderate view. And, return expectations have got to be realistic.
And last question, and these companies you're investing in, are these companies that have been beaten down in the last 4-5 months, or is it companies that are a completely different set, so to speak?
No, I think it's a combination of both. I think there are many companies, which have been beaten down. They're available at 70, 80% from their peak level. There are some companies which have got listed about 3-4 months back and which have done very well over the IPO price. But what we see essentially is growth, Govind. I think growth is something which we bet on. And I think if the growth quotient is very high, it's very encouraging and the promoter quality is strong, then I think you need to take a reasonable bet. I mean, at least out of 100 rupees investment, we try to put at least 20, 25 rupees in such companies because we know that these companies click, they can make a multi-bagger return. And see, ultimately, we are all here in the market to make capital growth, much significantly. I think for us, 15% returns, Govind, is not something which excites us.
Avinash, that's a good note to end on. Thank you so much for joining me. A new income tax bill is presented. The important point is that nothing much is likely to happen at least till next year. The Finance Minister Nirmala Sitharaman presented the new income tax bill, which is called the Income Tax Bill 2025 in the Parliament on Thursday. The minister also asked the Lok Sabha Speaker to create a standing committee that will review the newly tabled income tax bill according to the business standard. The new bill may also take some time to be passed in Parliament as it will be sent for review by the committee and then a few more hoops, all of which are important. So the new law is likely to take effect only from April 1st, 2026. The shrunken version of the IT Act has no major changes and aims to simplify the tax system by using clear language, removing unnecessary clauses, and expanding the definition of income. To understand how we should be interpreting this new law, particularly in terms of its applicability and practicality right now, I reached out to Chartered Accountant Ajay Rotti of Tax Compaas. And I began by asking him, what was the significant development, if any?
New income tax bill, no doubt there are changes. There are some changes, but it is more of the same thing. And the reason is it was a stated objective. The FM was very clear that there's not going to be a fundamental change in the way tax works or the structure. And it is more of simplification of the language, cutting out sections which are redundant and cutting it in size and making it simpler, etc. So there was never an attempt to change anything drastically. Like we had discussed the last time you and I spoke, I don't think I expected anything big to be changing. And to that extent, it's on the same line. A lot of the language, a lot of sections continue from what it used to be with minor changes. Of course, some of those minor changes are important changes, which does simplify the language a bit. Some sections have moved into a table, etc. As with every other thing, this comes with its own plus and minuses, and we'll have to see once it settles down. Some of it could create new issues which don't exist today. We can't rule that out. Let's see what the select committee is going to do. They're going to, I'm sure, hear people, take some inputs in what final shape it would come out. But on a few counts, it is, I would say, it's not changing anything very radically. The old jurisprudence should continue. Some of the old settled principles should continue. To that extent, it is new and it is a bit old, like you said.
So give me an instance of something where you feel that while there has been an attempt to simplify, it's not maybe working exactly like that, or maybe it's having the reverse effect.
So let me take something very simple and which people will be able to relate to without getting into too technical details on sections. Now, we had multiple payments which were subject to TDS. Now, if you received interest from a bank who do TDS at 10%, professional fees, if we received, the company paying it would deduct at 2%, dividends would be a different rate, different section, etc. Therefore, there was a plethora of sections, to be technical, from 194 going up to 194R. So there were whatever 15, 20 sections which said if it is this kind of payment, 2%, if this kind of payment, 5%, commission, 10%, so on. What they have done is they have clubbed that entire list into a table and put it into one section. Now the table has different rows to say if it is rent, X percentage, commission, Y percentage, etc.
That sounds like good news.
It is, but it's not gone the whole distance with. Because one thing they could have done is done away with 10 rows, done away with 5%, 2%, 8%, 6%, whatever, and 15%. They could have just said all of them will be or club 3-4 categories, etc. So while there is a bit of simplification to put it into one section and into a table, but when you're doing something like this, you could have gone the whole hog, number one.
But was changing of rates part of the remit of this whole exercise?
It was not, but here, remember, the TDS is not a tax rate. It is just a deduction and it's an advance collection. So it does not technically impact your tax collections. Either you end up refunding if it's more, or if it's less, the recipient pays the taxes. So it does not impact the collections as in the revenue targets. It may impact cash collections. So there are one or two things like this where they could have probably gone a little further, even in simplification. And some of the issues which were there on interpretation, for example, it was there as an explanation or a proviso, to use a technical term. They have now said that those are gone, but those have come in as a subsection or a note below this table and things like that. So it's sort of, yes, a bit of simplification, but some of the legacy issues may still continue.
The bill itself has shrunk. I mean, the number of pages has definitely come down by about 200 or so, right?
See, that was expected. And I'll take an example again, COVID. While the current Income Tax Act was there were a few sections like 80HH, EHHC, and I'll tell you what they were for. They were export benefits for which had long gone. 2011, some of them were gone. Some of them were gone 2015. But they were there still in the statute. And the subsection said nothing in this section shall apply after a particular date. So while there were 800 odd sections, there were a lot of sections which were in the statute but had no place, nothing they were doing. So now they've cleaned that. So you could have taken out these omitted sections long back. It does not make a difference. We were never reading that. Those were never applicable. Yes, there is a number thing that it reduces in size, but those were anyway not relevant even earlier.
Right. So what's the one, let's say, refreshing part that you've taken away from this, which suggests that directionally we are maybe headed in the right direction?
It may sound a little bit contradictory, but I think we've not done too many changes. That's one good bit, because we don't disturb everything completely in the desire to simplify things. So the overall structure remains the same. The overall arrangement of the sections is a little changed, but not too drastically. They have a saving provision for all the circulars, notifications, clarifications issued under the old act. So in all that, it is good. But there will be some problems with two parallel acts running for a few years. Notices coming under the old act and under the new act, because the bill says that this will apply only for tax years after 1st April 2026. So before that, the 1961 Act continues. The last point, and I think this is the most important change, is this whole concept of assessment year was very alien. When I talk to foreign tax heads, global tax heads, they just couldn't understand this concept of assessment year, financial year, and why do we call it assessment year, which is a year ahead of the tax year. That's completely proposed to be done away with. In my view, that's the single biggest change, not really all other things. That changes a lot, eases compliance, eases some bit of understanding, reduces a bit of confusion. Overall, I think there are a few good takeaways, but we could have done a lot better, as with anything else.
And we still have time because this is now going to go to a committee. A committee may give some recommendations which may be along these lines, or
the committee could consider some of the inputs, and we have a lot of time now because it's the first day of the next session, and whenever the fifth session, the monsoon session starts, we'll have to wait until then. It also depends on what the remit of the committee will be, because if you heard said the speaker can decide what contours of the committee will be. That will be the thing that we will have to watch out for. One thing that still continues to bother me is there's a lot of change that the department will have to do to their systems, IT systems, their websites, their forms, the way it is working, because all section numbers have changed.
Ajay, always a pleasure speaking with you. Thank you so much.
Thank you, Govind.
Gas deals. A flurry of agreements have been signed at the India Energy Week on right now in New Delhi, where your correspondent has also been making the rounds. These agreements are for importing liquefied natural gas or LNG for long-term sourcing. The interesting thing about LNG contracts, as an aside, is that they usually run between 10 and 20 years and may not start for a few years. And that's how the demand-supply dynamics work here. In this case, predicting demand ahead is always a challenge, according to a senior official of the Gas Authority of India Limited, who was speaking at one of the sessions. Speaking of Gas Authority of India, or GAIL, I spoke last week to Sandeep Kumar Gupta, Chairman and Managing Director of the company, who, by the way, is a chartered accountant, unlike most of his peers who hail from engineering and technical backgrounds. I began by asking him about the role of gas in India's energy mix as it stands today and the pathways forward.
So, as you are aware that in the energy basket of India, the composition of gas has been around 6% only. And Honorable Prime Minister had a vision of increasing that share to 15% by 2030. Unfortunately, that has not happened, and it is still at the same levels. The reason is that the energy demand of the country is growing rapidly because, as you are aware, that in the last decade, we have progressed from 10th largest economy to 5th largest economy, and we are progressing very fast. So energy demands of the country have increased, whereas the natural gas consumption per se, in terms of percentage, has not increased, though in absolute terms, definitely it is increasing, but it is almost the same percentage as it was earlier in the energy basket. We are producing about 50% of natural gas domestically, which definitely has increased. That is why it is maintained at 50% level, and 50% is imported. The large producing geographies are Middle East, mainly Qatar, and then United States, Russia, Australia, and some other parts of the world. And we have been sourcing from every geography. In fact, I must tell that we have a very good portfolio of natural gas long-term contracts, which were hitherto about 14 million tons per annum. And we have recently increased it to more than 16 million tons per annum, securing energy for India. So the progress is there, but because in a total terms, the percentage is not increasing. The reason is that there are certain incentives which need to be given for a growing energy, which is natural gas. The conventional fuels like MS, HSD or LPG have been there in the country for more than half a century. And to displace those energies by a new coming energy is extremely difficult unless it is given due fiscal supports. So we hope that some supports will be given, and then perhaps the natural gas consumption can take off from these levels.
If I can maybe draw you back to take us through some history as well. So the first pipeline that Gas Authority of India set up was maybe in 84. And then subsequently, the company has grown in two ways. One is the pipelines have grown. The utility or the usage of the gas has grown from what it was originally envisaged. And GAIL as a company itself has diversified. So take us through.
Yeah, we started with the HVJ pipeline, and now I'm glad to inform you that about 70% of the natural gas pipeline in the country is owned by GAIL India Limited. We have more than 16,240 kilometers of pipelines out of our total about 22,000 kilometers of pipeline. And we are executing projects which will ensure that another 3,000 to 4,000 kilometers of pipelines will be commissioned very, very shortly. In fact, many of those pipelines will get commissioned in the current calendar year itself. So it has progressed very well. About 70% of the natural gas pipelines is owned by GAIL. About 65% of the total transmission happens through GAIL India Limited. Almost 50% of the natural gas consumption in the country is serviced in terms of sale, by GAIL India Limited. So we are the leading natural gas company. Out of the total 307 geographical areas in the country for city gas distribution, GAIL and GAIL Group companies own 72, which is good 1/4 share in the total city gas distribution. We own about 65% of the domestic PNG connections which have been authorized by any entity. And we have about 40% share in the CNG stations which have been put up in the country. So in the natural gas vertical, definitely GAIL is playing the leading role and have lion share in most of the business. Besides that, we have diversified into other areas in the gas value chain. In fact, you would be astonished to realize or know that GAIL India Limited is the first company to put up a petrochemical plant in Pata, which was in Pata and got commissioned in 1999. Of all the existing public sector players, GAIL was the first to set up that plant using gas. We crack gas. And then thereafter, we have expanded that particular capacity. And we have also 70% stakeholder in the Brahmaputra Cracker and Polymer Limited, and also have a stake in OPAL, that is ONGC Petro Additions Limited. So our total petrochemical capacity, which is presently about 11% in the country, we are also planning to expand that capacity. We are putting up a 500 KTA, country's first propane dehydrogenation polypropylene unit at Usar in Maharashtra, and have also acquired a 1.25 million ton PTA plant from erstwhile JBF Petrochemicals at Mangalore. And we are putting up a 60 KTA polypropylene plant at Pata, in addition to the polyethylene which is produced presently at Pata. So that will take our total capacity to about 3 million ton, perhaps by end of this calendar year itself. So in that direction also we have progressed very well, and definitely then we have our presence in the new energy verticals also of renewable, etc.
So you had earlier talked about a 30,000 crore capital expenditure across different verticals. But as you look ahead, is GAIL more a petrochemical company or a gas company, or is it a blend of both?
We are primarily a gas company, natural gas company, and our major capex comes from pipelines only, natural gas pipelines only. And as I mentioned you, we are currently executing a lot of pipelines like Mumbai-Nagpur, Jharsuguda-Jabalpur pipeline, which will get commissioned in this calendar year itself. We recently commissioned our Srikakulam-Angul pipeline and gasified it. Prior to that, we had commissioned our Barauni-Guwahati pipeline. Urja Ganga is almost complete, except for these two sections, which are Durgapur-Haldia and Dhamra-Haldia, which also we are planning to commission in this particular year itself. We are also completing Kochi-Kotinad-Bangalore pipeline, the Tamil Nadu section of which was pending. And we are confident that we will complete that also in the current calendar year itself. And besides, last year, we won the Gurdaspur-Jammu pipeline in a bidding round. And we are working on that particular pipeline also. So our major capex comes from pipelines only. We are also planning to put up, as I mentioned, we are doing Usar project and Pata project for polymers. So some capex is in that also. We are reviving Bangalore plant, which we acquired at the investment of 2,100 crores, and we are investing another 2,100 crores for its revival. So some capex is in that. And as you are aware, we advanced our net zero target for scope 1 and scope 2 100% from 2040 to 2035, and we have drawn up roadmap which will entail an expenditure of 38,000 crore by 2035. So that will also feature in our annual capex. And besides, we are planning to put up a world-scale ethane cracker, a new greenfield ethane cracker. The work is the feasibility of which is being worked out, and if it gets approved, then definitely it will entail a lot of.
I'll come to ethane in a moment. It's sort of layman's question. You're laying a lot of pipelines. Even this year, you've described at least 5 underway. How do you set up a certain pipeline? I mean, is it demand-led? Is it project-led?
So depending upon the requirements, because as you are aware, as I mentioned, Honorable PM has a vision of increasing the natural gas share from 6% to 15%. That will not happen unless the pipeline network reaches each part of the country, because that is necessary not only to service the city gas distribution network. The whole of India is now authorized except for Andaman, Lakshadweep and Ladakh. So we have to reach the natural gas pipelines as near as possible to the city gas distribution networks. But it is also necessary, this network is also necessary to service the industrial customers. So there are a lot of fertilizer plants or power plants or steel industries or refineries or petrochemicals which will need these pipelines for natural gas consumption is those factories. So we have to lay these pipelines to service them. Now, how these pipelines are put up? Now, no natural gas pipeline can be put up by any entity at its will. There is an authorized agency, which is Petroleum and Natural Gas Regulatory Board, which is a regulator for natural gas sector, who basically invites expression of interest from entities. And based on that, there can be a bidding route or there can be a nomination. So some of the pipelines which GAIL has executed or is executing are based on nomination, and some we have one in the bidding route. So that UI which PNGRB floats is based on assessment of the demand by them. And at sometimes the entities can also approach PNGRB to issue an UI depending upon their own assessment of the demand in a particular area.
This segment was supported by the India Energy Week 2025, scheduled from February 11th to 14th in New Delhi, and you can register for the same using the link in the show notes. Honda and Nissan split. Honda and Nissan have officially scrapped their planned merger less than 2 months after announcing it, which puts pressure on Nissan to look for more or other partners. The two Japanese automakers had said in December that they planned to combine operations by 2026, but talks quickly broke down, reports the Wall Street Journal. Honda had initially agreed to a merger of equals, but the two companies said on Thursday that Honda later sought to make Nissan a subsidiary, and that shift angered Nissan's board, according to people who spoke to the Wall Street Journal. However, the company said they would continue a collaboration on auto technology that was announced last August. Nissan had said in November it would cut 9,000 jobs and reduce global capacity by a fifth after facing troubles in two of its biggest markets, the US and China, said the Wall Street Journal. Taiwanese electronics manufacturer Foxconn, best known for assembling iPhones and other Apple products, is a potential suitor for Nissan. Yang Liu, Foxconn's chairman, said on Wednesday he was open to collaborating with Nissan but doesn't intend to push for an acquisition. Liu said that Foxconn had been in discussions with Renault, Nissan's long-standing French partner, regarding a cooperation. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.